Did you know that once you reach a certain age, the IRS requires you to withdraw money from your retirement accounts each year? These are called required minimum distributions, or RMDs, and missing them can cost you up to 25% of the amount you should have withdrawn. I am Jeff Panic with Balanced Wealth Partners, and let me explain what you need to know to stay compliant and maximize your retirement savings. A required minimum distribution is exactly what it sounds like: the minimum amount the IRS requires you to withdraw annually from certain tax deferred retirement accounts. This includes traditional IRAs or 401ks, 403bs, and similar accounts. The government gave you a tax break when you contributed to these accounts, and now they want to ensure you eventually pay taxes on the money. RMDs force you to start drawing down the accounts rather than letting them grow tax deferred indefinitely. An important note: Roth IRAs are exempt from RMDs during your lifetime since you already pay taxes on those contributions. Your RMD age depends on when you were born. If you were born in 1950 or earlier, you start at RMDs at age 72. If you were born between 1951 and 1959, you begin at age 73. If you were born in 1960 or later, you'll start at age 75. Your first RMD is due by April 1st of the year after you reach your RMD age. After that, all subsequent RMDs must be taken by December 31st each year. Here's a key strategy tip. Consider taking your first RMD by December 31st of your RMD year rather than waiting until April 1st. Why? If you wait or delay, you'll need to take two RMDs in the same tax year, potentially pushing you into a higher tax bracket. Your RMD is calculated by dividing your account balance from December 31st of the previous year by a life expectancy factor from IRS tables. For example, at age 73, you divide your balance by 26.5. If you have multiple IRAs, you can calculate each separately, but can take the total from one or more accounts. However, for 401ks and other employer plans, you must take RMDs separately from each of these type of accounts. You have several flexible options for taking your RMDs. Timing flexibility. You can take it monthly, quarterly, or as a lump sum. Just meet the annual deadline. Tax withholding strategy. You can have taxes withheld from your December distribution to cover your entire year's tax liability, even if you took earlier distributions without withholding, or you could withhold taxes on distributions as you withdraw. Charitable giving. If you're 70 and a half or older, you can donate up to $108,000 of your RMD directly to charity through a qualified charitable distribution. This counts towards your RMD, but isn't included in your taxable income. Investment strategy. You don't have to spend your RMD. You can reinvest it in a taxable account, though you'll still owe taxes on the distribution. Missing an RMD deadline triggers a 25% penalty on the amount you should have withdrawn, plus regular income taxes. However, don't panic, no pun intended. The IRS may reduce the penalty to 10% if you correct the mistake within 2 years. You can also request a complete waiver by filing Form 5329 with a letter explaining reasonable cause, such as illness, incorrect financial institution advice, or confusion about the rules. The key steps if you miss an RMD: take the missed distribution immediately. File Form 5329 with your tax return. Include a detailed explanation letter. Don't pay the penalty upfront while requesting a waiver. RMDs don't have to be complicated or stressful. With proper planning, they can be integrated smoothly into your retirement income strategy. The key is understanding the rules, planning ahead, and considering strategies that align with your overall financial goals. If you'd like help calculating your RMDs, exploring tax-efficient strategies, or ensuring you never miss a deadline, I'm here to help. Let's schedule a time to review your specific situation and create a plan that works for you.